Hi everybody, this is Jonathan Tran from Paramic Financial. We're back again with Finance in 5 to 10 minutes, and we're continuing our series on life insurance. This time we're going to talk about a topic, indexed universal life insurance, which is a very popular type of life insurance right now. Probably within the last 10 years has been the top selling type of life insurance sales, like growth-wise. And why do people are moving towards indexed life insurance? Indexed universal life insurance is a form of permanent policy. So depending on how you design the policy, it can be used to fund your life insurance for your whole entire life. Now there's different ways that you can utilize the indexed life insurance, but primarily, of course, it's a life insurance policy. So if you pass away, your money that will be paid to your beneficiaries should be tax-free if you do it correctly. Now, other people also use the indexed life insurance to add on extra benefits such as long-term care. So in case that, hey, what if I buy this indexed life insurance and if I don't pass away but I become chronically ill or sick, well, hey, you can use the money from the indexed life insurance benefit and accelerate the benefit and use it before your death. And usually they let you take a percentage of it. So it could be 2%, 4% of your death benefit. For example, if you bought a $500,000 policy, you became chronically ill or disabled, and you couldn't perform two of the daily living activities that you qualify for long-term care, they will allow you to take, if it was 2%, you can take up to $10,000. If it was 4%, you can take up to $20,000. Now, the tax implications on that is the first $10,000, you don't have to pay the taxes on it. The second $10,000, you need to make sure that you have receipts of what you're using it for. Otherwise, it could be taxable to you, right? So the indexed life insurance, very flexible. You can use it as a life insurance policy. You can also use it for a long-term care benefit as well. But the index portion of it, people may ask, hey, what's the index portion? Well, the index portion is how the cash value grows. So what it does is it follows a crediting strategy of a particular index. Let's just say, for example, the S&P 500. And so the life insurance policy cash value will follow the S&P 500. And depending what it does, you know, from point A of last year to point B of this year, whatever the difference is, there could be a crediting. So there's a positive gain. There will be a positive credit to the cash value. Now, the special thing about the index policy is that if there was a negative crediting to the index, then there's no loss at all on the insured's part. So you have a policy that has what they call a cap and a floor, meaning that they may cap the gains that you may have, but they'll have a floor where you may not lose any interest at all. Now, there's more strategies within there where you can, pay a point to earn more interest, or maybe you put your strategy where you wait a couple years to get credited at your strategy. They may give you a participating rate. A participating rate means that you can gain more than what the actual interest is. So say, for example, you earn 10% in that crediting period, but because you selected a certain strategy that gave you a 150% participating rate, then that 10% will be multiplied by 150%, and now you made a little bit extra interest, right? So there's different strategies. It can get kind of complicated, so you want to make sure that, when you sit down and you are considering a indexed universal life insurance, one is to make sure that, okay, it's suitable for you. Is it within your budget? And making sure that when you fund this life insurance policy, what is your goal? Is your goal just to buy life insurance? Well, then make sure that when you're buying the life insurance, there may be some guarantees in there. So that way, no matter what happens, if there's not enough interest credited, you're guaranteed that your policy is going to last for you. Or if you're using this as a form of supplemental retirement, then make sure that you remember that this is just not a life insurance policy, but it's actually a supplemental retirement. And when you want to retire, you have to save. And when you save, you're not just trying to find the cheapest policy, you're trying to find the best place to grow your money, to save. And so you have to make sure that you fund it as to the maximum potential that you can, right? So besides, like, say, your retirement account, your Social Security, and now you have this life insurance, and you want to use it as a supplemental life insurance policy for retirement, then make sure you fund it properly so that you have a nice nest egg in your retirement account, in your life insurance, and also in your Social Security. So Indexed Universal Life Insurance, a very powerful program, very popular, very good for those who are a little bit more conservative, but they want to maybe have more potential of gains than say a policy like a whole life where it's fixed. This is a very good option. The cost of it is very cost effective. You get to add on those long-term care benefits, and you have a lot of options when it comes to the index crediting strategies. So follow us in this series of life insurance. We talk about term life, whole life, index life, variable life, and see which one is appropriate for you. So follow us at the link below, like our page, share it, and I hope you guys learned a lot today. Thank you so much for your time, and we'll see you in the rest of the series. Bye-bye.